And welcome, Craig Stewart, again, and over to Dawn Conway to introduce him. Thank you, Dawn.
Thank you, Frank. And I must say, you've said it in your earlier comments just a moment ago. It's a very timely topic. I was just having a quick scan at the economic impacts, and of course, California, the estimate of damages and economic losses is now up to 150 billion. I can't even think in terms that large. So I think Craig must be extremely busy these days. Just a quick comment. 20 years ago, the economic losses associated with extreme weather were in the order of about 500 million a year. And over the last few years, they've gone up over 3 billion a year. So the trend is obvious. A lot of this is floods, but all the other things we can think of. The other thing, of course, is the impact on business, and business owners are overwhelmingly concerned at the impact on their businesses and their profits, and that's from a recent survey. So I think this is extremely timely, and we're delighted to have Craig as our speaker today. He's the Vice President responsible for climate change issues and federal issues at the Insurance Bureau of Canada. And he leads the national work of the Insurance Bureau of Canada on disaster resilience and climate change, and co-chairs the National Advisory Table on Disaster Resilience and Security. And for you oceanographers out there, he's also directed the National Oceans Conservation and Arctic programs of the Canadian branch of the World Wildlife Fund. He's considered one of Canada's foremost experts on climate adaptation, disaster risk, and nature-based solutions, and is extremely active on Senate and House of Commons committees, and so ideally placed for nudging the politicians to do whatever is required to have a rational climate extreme weather policy or policies. We all know that there's an impact on us, on our home and car insurance, and the losses are escalating very rapidly. And so the insurers are adjusting property coverages simply to remain in business. So I think this is a hugely important topic, and we're just delighted to have you, Craig. And without taking any more time away from you, I'll turn it over to you. We're looking forward to hearing your comments. Thank you so much.
Well, thank you, Dawn, and thanks to you and Frank for the invitation to speak today. I have a long familiarity with CMOS and the work that you do, the important work that you do. When I discussed the subject for the talk with Dawn, we couldn't have anticipated what was about to happen in California, and so the timing is sadly fortuitous. But at that time, we talked about discussing the future of insurability in an era of climate change, and lo and behold, that's become. I've probably done, I don't know, 20 media interviews on this topic over the last week, even though we designed this, a month or two ago. So I thought that I would just dive in and talk about, try to answer several questions. That are top of mind for policymakers right now, as well as journalists and probably a lot of home and business owners. And those are, given mounting catastrophic losses from severe weather as we're witnessing, will homes and businesses remain insurable into the next decade? And I'll talk about why that matters. I'll talk to the trends in insurance that we are now seeing, because we are seeing market movement now in Canada. And I'll speak to what can we do to keep the country insurable into the next decade. So, typically we start these presentations with a conflagration, but I think you're probably saturated with images of Los Angeles burning at this point. And so what I wanted to do was talk about, which is what we're thinking of as what's next. So this is Fort St. John in northern British Columbia. These are the type of community. A year ago, Fort St. John was under threat. We got lucky, the risk subsided. But these are the communities we're worried about. You know, and we get the questions, could a Los Angeles type event happen in Canada? Well, of course it could. We just had the unfortunate event in Jasper, which is frankly a community that did a lot right. But we've got but we have a number of communities exposed across the country. And here in Nova Scotia, where I live, we had a real scare 2 years ago when we got frankly very lucky when the Tantalin fire, the wind direction switched, and we ended up avoiding a catastrophe in Lower Sackville, which is a suburb of Halifax. And so, are we at risk? Of course, we're at risk. Is there a likelihood that we're going to see an event, another event like a Fort Mac or a Jasper? Yes, unfortunately, in Canada, and that's what we need to be thinking about is how to prevent that. So where are we at now? Well, you know, there's a lot of focus with these events on response. How do we respond? And there's a lot of focus on, you know, wildfire response, for instance. There's not enough focus on response to other perils, and there's certainly not enough focus on recovery. And that's been our messaging to the federal government is we need to develop a culture of preparedness, and specifically preparedness to recover in this country. We don't do a great job. You can look at Lytton as a key example, but there are others, Merritt, Port aux Basques, where, you know, we have communities that take years to recover from these events. And if we did a better job with preparation, you know, obviously mitigating disaster risk at the outset, but also organizing ourselves to recover, you know, we'd be better off. And insurance is a key tool to disaster recovery, but not the only one. And what this means, sort of the key elements of this are, you know, we have a lot of people across the country that are simply unaware of their risk. They don't know that they're at high risk of wildfire, or they're at high risk of flooding. They don't, or they discount the risk if they, you know, where I live, we're very familiar with hurricanes, but we just think it hasn't affected my home so far, so it probably won't affect it in the future, and that tends to be a mindset. And so somehow we have to figure out, when we talk about a culture of preparedness, how we shift that. Communities are unfortunately ill-prepared to assist residents and businesses during and in the aftermath of an event. We tend to reinvent recovery every time. We've experienced this in Jasper. Unfortunately, we don't have any sort of central resource or agency, and I'll get back to this in a bit, that assists, takes lessons learned from events and applies them in other parts of the country. That just doesn't exist. So it's left to municipalities to you know, start from scratch after every event without having learned what others have done. And we experienced this with Jasper and in Parks Canada, where there simply weren't the learnings from Lytton or from Fort Mac that could have been applied, and it led to confusion and delays in the aftermath of the wildfire. And governments tend to allocate funds through just-in-time or after-the-fact programming. They focus on ex post instead of ex ante programming too much, rather than designing recovery programming thoughtfully from the outset. And we're still treating these events as we did a decade ago, you know, as one-offs, that these are flukes. They're not flukes. They're no longer flukes. This is a trend, and we need to now expect that you know, we're going to have more hurricanes, we're going to have wildfires that are going to impact communities, we're going to have flooding in major urban centers, and we are definitely going to have another big hailstorm in Calgary, and we need to prepare with that knowledge. So now I'm going to dive into insurance and just give a little bit of a primer on insurance. I'll do my best not to keep it dry. So insurance is designed to transfer risk, away from those who cannot afford a financially devastating loss, and to diversify and backstop that risk, either through global capital markets or government treasuries. At its best, is designed around incentives. So insurance ideally is there. So those at risk pay a premium for the transfer, and those premiums are reduced when that risk is reduced. It's meant to price and provide those incentives. Without insurance, banks would have to scale back on mortgage lending. Home and business owners would have to use retirement savings to pay for loss events, and so on. Insurance distributes risk from unforeseen accidents. If an event is accidental, it's insurable. So car accidents is a prime example. You can't predict, or usually you can't predict when a driver is going to be prone to having an accident. Insurers collect premiums, so they underwrite, and then they invest those premiums to generate return. They're supposed to maintain sufficient capital and liquidity to pay out claims, and ideally they generate a profit. That profit in Canada is fairly consistent. Insurers in Canada over time have maintained pretty much a 10% profit on a year-to-year basis. That went up when no one was driving cars in Canada during COVID, and insurers benefited from that because they weren't paying out claims. But in certain parts of the country, insurers lose money year after year. And certainly in this country, in Alberta, insurers operate on an ongoing loss in order to maintain a presence in Alberta. Reinsurance is key to insurers' ability to manage their risk exposure. So reinsurance, reinsurance companies are big global companies that essentially provide insurance to governments and to insurance companies. So they backstop insurance companies. So what that looks like is an insurance company will bundle its risk. It'll take risk on from a homeowner, bundle that with other homeowners, and then buy a reinsurance policy, which means they're basically passing on a portion of that risk and paying a premium to a reinsurer so that they don't hold all of that risk on their books. Insurers have different strategies when it comes to reinsurance. Some buy more, some buy less. And often a reinsurance product triggers based upon the scale of an event. So if you have a single event that costs a lot of money for an insurer, there's like a threshold where they say, if it passes 500 million, the reinsurer will pay out this much, like 20%. If it passes $1 billion, they'll pay out 50%. So it's sort of, there's a gradation. The takeaway from this is that single events are easier to reinsure and easier to manage for an insurance company. Like the Fort McMurray wildfire that happened, most of the cost of that event was borne by global reinsurers, specifically Munich Re. But when you have a number of small events across the country, which has become the norm in recent times, or even medium-sized or large events, then it hurts insurers more because it doesn't penetrate their reinsurance policy as much. And so that's caused in this country some difficulty for insurers, is because you have a multitude of, $100 million or 200 million or even $800 million events. Most of that ends up on their books as opposed to triggering the reinsurance policy. The 5 key property risks that are insured are 4. These are common to every insurance policy: fire, wind, and hail. And wind would include tornadoes and hurricanes. And then 2 auxiliary risks, which are flood and earthquake, which are usually handled, in the case of overland flooding, handled through additional endorsements. So you buy those separately. And location is the primary consideration. So an insurer takes a look at where you live, what you're exposed to based upon claims history and modeling, and determines, okay, how high is your risk level based on your location. And then construction is the secondary. So the secondary consideration, they'll take a look at your home, how it's built with a particular emphasis on the roof and the siding. And then your premium will be set based upon those two measures. What changes have we now been seeing in the market? And this background is probably essential to understand what's happening in California. So back in, it actually started in 2019. Lloyd's of London took a look at where it was making reinsurance available around the world. And instead of just simply keeping it fairly consistent and spreading the peanut butter evenly around the globe, they changed their strategy and said, boy, given our losses, there are areas in the world where we're more highly exposed. And it's becoming clear that those are less safe places to be doing business. And we're going to lower our exposure to those places. And so in 2019, Lloyd's pulled out of certain markets, and unfortunately, they pulled out of Canada. And Lloyd's was the #1 commercial insurer in this country. And so when Lloyd's pulled out, it meant that a number of businesses could no longer get insurance. We worked very hard to try to get more capacity into the Canadian market, have other reinsurers step in order to fill that gap. But as we head into a pandemic, a number of hospitality-based services in particular and tourism operators couldn't get insurance. Lloyd's eventually returned to the Canadian market. They reversed the decision in part. But in 2022, other reinsurers followed Lloyd's lead, and there was a huge global reset. And what that meant was other reinsurers took a look and said, we are either going to significantly raise pricing or we're going to pull out of certain markets overall. And what that meant in Canada and in the US is that reinsurance rates went up by as much as 100% in 2022. And so insurers then had to absorb that. And insurers had to make a decision. They could either, and this was all due to severe weather and catastrophic losses. They could either pass it on to their customers or absorb it themselves. And so when you read the news on what's happening in California with insurance, this is the driver. If you're an insurer and you're in a market where you cannot raise the premium because of regulation, which was the case in California, it no longer makes sense because you're paying much higher reinsurance pricing. You can no longer operate at a profit. It's impossible to operate at a profit in that market. And in 2022, a number of companies, Allstate, Farmers, State Farm, said we're no longer writing in certain areas of California, or we're not going to write new business, and in some areas they said we're just not going to renew policies. And you've probably heard that in last summer in the Palisades area near Los Angeles that has suffered the brunt of the burning, State Farm pulled out from 70% of its policies. This was the driver. This is what happened behind the scenes. The other challenge that we've had is that these wildfires that have been happening have defied our models. So we did not expect Munich Re did not predict the Fort Mac fire. It wasn't predicted in their models. No insurer predicted the fires that happened in Nova Scotia 2 years ago. And so there's a deep distrust of wildfire modeling now in the insurance industry, which means that they are buffering, they are operating, trying to, given that uncertainty, they're trying to manage that uncertainty, and they're being more cautious now when they're taking a look at what they should be underwriting. Another key factor is the Canadian federal government gave direction that when the National Model Building Code went through its 5-year review and update, it punted the resilience elements of the codes to make way for energy efficiency. And it meant that, and we were aghast at this as an industry, that essentially new homes would be built prioritizing energy efficiency, and it won't be until 2030 at the earliest that new homes will be built with climate resilience built into the building code. And that's problematic because we have a shortage of housing in this country, and we have now incentives to build about 1 million homes in the next 5 years, and they will not be built to be resilient to severe weather. They'll be, and so the question with our industry is who is going to insure those new homes? And there's pressure on those new homes to be built in places of high risk, because some mayors, such as in Windsor, have said, we don't have anywhere else to build. We have to open up floodplains to building. And so you package all of these things together and you begin to think, boy, we're on a bad trajectory, unfortunately. So, just a sec here. So, a little bit about protection gaps. Protection gaps are what insurers talk about when they talk about gaps that emerge in insurability, where simply home or business owners can't get insurance for certain reasons. And protection gaps occur for several reasons. Insurers decide not to cover certain perils because they can't be modeled. So landslides and tsunamis are not covered in this country by insurance. Insurers decide to reduce the concentration of their book of business in certain regions because risk is no longer regarded as accidental. So that would be floodplains across the country. And there's about 1.5 million homes on floodplains that are where the risk is no longer accidental. We know they're going to flood. And or reinsurance costs are too high to operate in those areas. And this is becoming a factor in Alberta and BC. And or price regulations mean losses are certain. This is not an issue in Canada. It is an issue in places like California. So insurers adjust products to keep premiums affordable. And this can result in a protection gap when your insurance coverage, the amount that you are able to transfer, shrinks. So you're paying the same or more for a smaller bag of potato chips, basically. So they raise the deductible, they lower the coverage limit, they increase exclusions, and that means that consumers may have more choice. They have a cheaper product, but they possibly have an inadequate protection for the risk that they face. And this is the issue that we're watching carefully in this country, because although we're not seeing the state farms in all states, we're not seeing insurance companies vacate markets in Canada, what we are seeing is that companies are reducing their exposure by reducing the product. And the biggest area where this is happening is hail around Calgary, where the product is changing and where after 3 events in 5 years that exceed $1 billion in losses, insurers are saying, we can't, this isn't sustainable. We have to do something. And so hail, which was part of the core coverage, is now being broken out. It's starting to become an optional endorsement. It's being priced that way, and the product is possibly being reduced. Market failures are also important to understand when you think about the trajectory of where we're headed over the next decade. Market failures happen because consumers misunderstand insurance coverage and are left unprotected. And this is very common. People don't read the policy. They don't understand it. Consumers misunderstand their risk and are unprotected. So often they don't. People aren't aware they're living in a floodplain or at high risk of flooding. Or are at high risk of pluvial flooding because of heavy rainfall events, which can now occur apparently anywhere. Consumers are inadequately aware of their risk and believe it's not worth the premium that they would pay. And this is the case in Quebec, where the risk is actually fairly great, but only 3% of folks in Quebec have earthquake coverage, as opposed to closer to 50% in British Columbia. Or government disaster assistance competes with insurance. So homeowners say, why would I buy insurance? The government's going to bail me out. I'm going to speed up a little bit just to make it, make sure I have lots of time for you to ask questions. Flood insurance is the particular quandary that we face in this country. Over 1.5 million Canadian homeowners can't access overland flood insurance, and are faced with hardship when an insurance event happens and they're not insured. So, for example, since 2016, Atlantic homeowners affected by flooding had to withdraw an average of $63,000 from retirement savings to make ends meet. And in order to address this protection gap, for the last 7 years, the industry has been working closely with the federal government to try to stand up a national flood insurance program. And I'm going to dive into that in a minute. I'm going to go quicker here. And the one area where you've probably heard our industry has played a very vocal role has been on the need for a national adaptation strategy and investments in adaptation to reduce the risk across the country. Unfortunately, the federal government has spent in the last 10 years, since 2015, although they've been commendably aggressive on reaching net zero targets and trying to be a world leader in that area, they've spent very little focus on reducing the risk from climate change here at home. And so roughly the ratio is 10 to 1. They've spent over $45 billion on emission reduction programming, and by our count, just over $4 billion on adaptation programming. And we think that imbalance has to be addressed. So what do we think governments need to do in order to keep Canada insurable? Well, they need to identify severe weather risk in areas across the country and ensure it is well communicated so Canadians and businesses have a better sense of what they're exposed to. We need to start building better homes in better places. We need to address that gap on building codes. We need to improve provincial permitting processes to try to make sure we're not building on the risk as we build all these new homes. We need to invest significantly in reducing risk for existing homes, from fire smart in communities to home retrofit programming to flood defenses. We need to invest in better response. We do a pretty good job on wildfire response, but we need to extend that knowledge and capacity to flood and extreme heat, where in particular with extreme heat, we do a fairly poor job on response. And we need to design insurance programming partnerships like a national flood insurance program that will flow money quickly post-disaster and streamline regulatory obstacles to rebuilding. We don't have a FEMA. We do not have a federal emergency management agency. We're one of the only developed countries that does not have a central agency like this existing. Instead, we have municipalities who are completely on their own to try to manage a rebuilding process, and without any mechanism to learn from other disasters, how other municipalities have handled this in the past. And I'm going to conclude by just talking about an insurance partnership. So when high-risk properties are no longer insurable, ideally there is some sort of partnership or mechanism to make sure that they can remain insured, that they can be, these properties can be insured through basically a state-backed program, which is delivered by the insurance industry. This exists elsewhere. If you think about Iceland, how is it possible that anybody affords insurance in Iceland, a country that's basically, built on, as a result of volcanism? This is Grindavik, which has been for the last 2 years exposed to lava flows because of volcanic activity just outside the town. In Iceland, every home is insured through a partnership between the 4 major insurance companies operating in Iceland and the federal government of Iceland. And so they have a catastrophic risk partnership to make sure that homes are protected, homeowners are protected. And home ownership would frankly be impossible or unaffordable if that didn't exist. And it's not just Iceland. There are examples of these insurance facilities around the world, all the way from Turkey to Japan to Australia. Flood Re in the UK is the one that's most analogous to what we're trying to do in Canada. In fact, every G7 country except Canada has such a facility in place, with Italy now developing theirs. And so we've been the slowest in this area. And without if we want to keep the country insurable going forward, these are the 4 things that we've been basically advocating to governments across the country and to political parties as we head into a federal election this spring, likely. If governments don't act, insurers will continue to reduce exposure in high-risk areas across the country, and we'll see an emergence of insurance deserts, which is what our federal regulator, OSFI, calls them. Home and business owners will increasingly bear the risk on their own and be increasingly reliant on taxpayer-funded bailout programs. Governments will face ballooning ex-post costs for disaster recovery, and economic performance will be affected as Canadian communities take longer to recover from more frequent disasters. So I've shown you, what we're asking for, what we think needs to happen to create a more resilient country, and the consequences of what will happen if we can't get there. Hopefully that was somewhat illuminating. I'll turn it back to you, Don, to handle questions from the group.
Thank you. I won't be handling the questions, but just to comment on what you said about Nova Scotia. I noted that the 2023 wildfires and floods, which I'm told cost 490 million in insured losses, that's not to mention the uninsured, they started at a time of the driest conditions since World War II. So clearly a link there. Thank you. Oh, back to you, Frank, sorry.
That's all right. I've asked Mike Bricklickish to look after the questions. Mike, if you would like to take over. We have a few in chat as well, and there's Dawn's comment that she's just made. I'll leave it for you to proceed. Thanks, Mike.
Thanks, Frank. Craig, thanks very much for that walkthrough, a very, very complex topic. When I read your abstract, the last line measures that the property and casualty insurance industry is advocating governments prioritize should, I underline should, property remain insurable into the next decade. That scared me when that word should. So thank you for carefully peeling back many things that I think underlie that word should, which is very, very scary. And, showing what happened in California and the complexity of why companies like Allstate pulled out. Anyway, we've got about 25 minutes left for Q&A. We've got 3 questions in the chat already, so I'll go through those in order. If anyone else wishes to add questions to the chat list, please do, or just send a note in the chat that you want to, and you can ask it yourself. So I'll start with the first question from Paul Beckwith. Mandatory evacuations abandon infrastructure to wildfires. What about training and equipping the public to save their homes? We had 2 days advance notice to abandon Jasper. And I think you touched on a bit of that in terms of building codes and what we're not doing. So that's taking action before the fire even arrives, but also staying behind to save. So could you please help Paul with his question?
Sure, and thank you, Mike. Paul, so when we were crafting the national adaptation strategy, this topic actually came up quite a bit. It came up in terms of extreme heat in particular. how do you identify and use family and community networks, Facebook groups, et cetera, in order to protect those who are vulnerable. But also, how do we do a better job at whether it's wildfires or floods, to train and equip the public? Like 85% of firefighters in this country are volunteer. A crazy number, and they're volunteer. They go through training. We rely heavily on them, and so we already have a basis for this, but we don't have. But it's focused squarely on wildfire. And so the question we've had is, can you train and equip the public? Can you use volunteer firefighters, fire forces also for flood protection? Is there more that we could be doing there rather than waiting on the military to be doing that? So how can we expand on community volunteerism? How can we better support them? And providing them the equipment, providing them the know-how to protect community homes from these events. Is there a role? Can we do a better job in alerting and using, social platforms, for instance, where community members can help each other when you've got an impending hailstorm about what to do to keep your safe and your property safe? It's unbelievable how many people leave their cars outside and just to get absolutely destroyed and then face financial losses as a result of it. And so, and to the point, 2 days advance notice to abandon Jasper. We've known for 20 years, given the fire loading, that a fire event in the national parks was a runaway fire event was imminent. There was there were people that said we need to be doing more controlled burns. Anyway, maybe that's another topic. But anyway, I hope I've answered part of that. Anyway, Paul.
Yeah. Yes. Thank you. Sort of a quick add-on to that is there's an awful lot of climate denialism still existing in the world. It's going to get a lot worse in the U.S. So the insurance companies, I think, can play a big role in prevent, in speaking out loud to the public about climate change and the risks and so on. And the other thing is the insurance company looking at investing in things like carbon dioxide removal or solar radiation management to try to cool the planet and avoid some of the worst effects of climate change? Because we're clearly not reducing our fossil fuel emissions.
That's a great question. I am unsure whether those would be big global reinsurance investments, and I don't know whether the reinsurers have been engaged in those discussions yet or not. I'm going to have to look into that. I know that there's been increasing look at how insurance companies can invest in risk reduction, and if there's a mechanism whereby there could be, where the benefits of risk reduction pay a benefit or pay a return to investors, and how you calculate that. And cooperators have been leading the thinking on that. And so in country, but with regards to the large scale projects that you just mentioned, and the scale of investment that they would require, I suspect there probably have been conversations, but
just the final thing is we've actually done a reverse geoengineering, if you like, project that's made climate change a lot worse in the last 2 years. We removed sulfur from shipping fuels, and temperatures is quite globally, both ocean temperatures and atmospheric temperatures in the last 2 years. So surely the insurance industry can look into what the International Maritime Organization is doing and say, hey, wait a minute, disasters are way up in the last 2 years. The IMO needs to reverse their policy of removing all sulfur from shipping fuels. It's becoming very clear in the science that that's the main reason why we've had this spike in disasters in the last 2 years. So thank you. Fantastic. Fascinating talk.
Yeah. Thank you.
Thanks, Paul, for continuing the conversation. On to Bob Jones now for a bit of a different type of question. In large events, are there any systems in place for insurance companies to be available for people with losses to claim? In other words, how can frustrations from busy phone lines or crashed websites or failing online tools be overcome? So looking at the other end of it, when you know what hits the fan, how do we clean that up?
Yeah, great question. I mean, we were, not going to hide behind it. We absolutely overwhelmed. I mean, the industry last summer, in 2 months, faced over 250,000 claims and 70,000 claims from the Calgary hailstorm alone. The claims call centers are usually located in Toronto or Montreal. There just simply wasn't the capacity. There wasn't the capacity within the insurance companies. There wasn't capacity to bring in adjusters. We didn't have enough adjusters in this country to be able to assess all that damage. I was party to our meeting with our CEOs saying, boy, we're not built for this scale of a sequence of events in such a short period of time. Now, to be fair, we'd never seen anything like it. $7 billion of losses in a 2-month period from 5 different events. It was double what we'd seen the year before, triple 3 years before, and 10 times what we'd seen a decade ago. But the industry has to adapt and figure out a way to manage that if this is indeed going to become is every summer, spring and summer, going to be like this? Hopefully not, but the industry wasn't built for it. So to answer your question directly, no, those systems are not in place at that scale yet. But there's recognition that we're going to have to grow that capacity if we're, given the near future that the new future that we appear to be entering.
Thank you for tackling Bob's question. And, maybe in many ways we almost need like a roving set of folks that can answer the phone rather than being tied to one region or one company. But I couldn't imagine trying to put that into operation. Wow. Another question, this time from Kristen Wansbro. Given the losses Canada has experienced in the past year, if implemented correctly, is Canada's adaptation strategy robust enough to address this growing risk? So you've spoken already to how reducing our CO2 footprint has gained lots of attention, but the risk side of it, that transition to a net zero economy, is a long way away. And so I think it's asking, do we have anything in the adaptation strategy that will help us get there?
Hi, Kristen. Thanks. Good to connect again. And great question. So the answer is yes, with an asterisk beside it. So the National Adaptation Strategy, which was released 2 years ago, has a set of targets, which, if implemented, if followed, if attained, would address the growing risk. It was, in our view, a landmark achievement because it was the first national adaptation strategy anywhere in the world that contained targets, time-bound targets. Unfortunately, the Liberal government has been very slow to fund and to implement against those targets. The roadmaps for achieving those targets are not clear how they're going to get there. And now there's a good chance we're going to face a change in government at some point this year. And it's unclear to us whether a new government would embrace that adaptation strategy and possibly feel bound by it. And so that's our work. That's my marching orders from our board is, we really need to make sure that the next government takes it seriously and commits to attaining those targets. The strategy is meant to be iterative. It's meant to every 5 years be reviewed and changed. So if there are gaps, as you allude to, we would like to. There is an opportunity to iterate it, improve it, etc. But job one is let's make sure we're on track to meet the targets that are already in there, because there's great stuff there that would reduce would increase our disaster resilience if met and taken seriously.
Thanks, Craig. The next question, it picks up on a theme you touched on a few times, and that is people either don't understand the risk, aren't knowledgeable about it, or if they are, they often discount it. And so the question from William Smith is, are there publicly available maps showing the degree of risk for Canadian communities or parts of Canadian communities for different types of risk, particularly fire and wind?
So the very, very important question, and we get this question quite a bit. The answer is there are publicly available maps, but they're fragmented. They're mostly at the municipal level. Certain municipalities have them, others don't. And so it can be difficult to access. The federal government has agreed to set up a risk portal, starting with flood, where you can enter in your address and determine your hazard and what you can do, what hazard you're facing, and your exposure to it, what you can do about it. They were funded to develop that portal. It was Public Safety Canada, based on their Flood Aware website 2 years ago. We know it's in development, but we're unsure of when they're going to launch it. The intention was to start with flood and then extend to other perils. The problem with fire and wind, though, as I mentioned earlier, is that the models aren't great. And so, even as insurers that probably have some of the best data out there, we don't necessarily trust our risk models. And so to tell someone you're low risk and get it wrong is problematic. And so, and wind is notoriously difficult to model. So whatever we come up with, or whatever Public Safety Canada comes up with for those two perils, will be pretty coarse and will be based upon previous loss experiences, I expect. But what you're getting at there, which is elevating community awareness of risk by having some easy place that they can go to and determine it, we absolutely need to get there. It's a little bit challenging at the moment.
I ask a follow-up question on that is in the real estate industry, when a property changes hands, is there any obligation of the real estate industry to point out that, hey, you're buying a place that's been flooded out 4 times in the last 10 years, or is it buyer beware? No, the Canadian real estate industry is facing a real quandary. Their growing liability risk for their brokers and agents has escalated in recent years. There have been lawsuits when someone buys a home, isn't informed of the flood risk, and then the home floods. And so a couple of companies like Royal LePage have actually contracted American outfits, because that was the only place they could find it, to create basically a climate risk score in real estate listings. And that's driven by the fear of liability. And so Royal LePage hired a company called Climate Check out of the United States, because it was a stopgap measure, but they intend to put risk scores on every real estate listing. In the US, Zillow now has a climate risk score on every listing on Zillow. I can't remember. Oh, they've sourced that from an outfit called First Street Foundation in the US. And the Calgary Real Estate Board has committed to putting risk scores on all of the listings available through realtor.ca in the Calgary area. So they're trying to grapple with it. The problem is that the underlying data, in particular from the American firms, is we don't know what they're using for modeling up here. It's likely not great. And so it may give information that will cause confusion in the marketplace, because someone will buy a home, they'll get a climate check score that says you're at low risk of flooding, and then they'll go to their go to get insurance, and the insurer will say, no, that's not right. You're actually at high risk.
and then that will cause problems. But at least they're trying to tackle the issue, and the regulators across the country are on it and are trying to figure out, okay, how do we align these things and do a better job, at point of sale with real estate, at point of sale of insurance products, how do we make sure this stuff's aligned?
Thank you. Another question has popped up from Paul Beckwith again. Can you talk a bit more about reinsurance companies? Many are based in Bermuda. I understand, did Lloyd's pull out of other countries? Are the Res backed by government?
Yes. So the main Res are not backed by government. The main Res are backed by, so this would be companies such as Swiss Re, Munich Re, Paris Re, Hanover Re. They are typically based in, they're typically capitalized in Europe or in the United States, but based in Bermuda, head offices in Bermuda for tax reasons. And they're big global companies that basically make their money by investing in the capital markets and are backed by the capital markets. And they play a significant role in both catastrophic modeling and in backstopping both governments and backstopping insurance companies around the world. Lloyd's, yes, Lloyd's pulled out of a number of countries around the world. Canada was just one. And they started a trend where other reinsurers have now reassessed their risk and decided to reduce exposure in certain parts of the world, and that has unfortunately affected Canada.
Just to add to that, next week is Davos, and I think one of the top issues is the ability of insurance to exist in this world of more and more rough climate change. And also a very important report just came out earlier today by actuaries saying that society is basically not going to be financially viable in a certain period of time at all, not just insurance companies, but governments everywhere because of the ravages of climate change. So we're kind of in the soup here.
Was that Actuaries Canada? Was that the Canadian outfit or global?
I'll try to find the link and put it. It's if you just Google, they had a special name for it. I'll try to find. I need to find the link. I think it's global. It's a whole. I don't think it's a Canadian report.
Paul, can you share that with Frank and he'll send it out to the gang by email that, because we have a couple more questions here.
Right.
Okay. Thank you. We have Richard Aslan has his hand up. So Richard, could you ask your question, please?
Yes, my question is about artificial intelligence. Is there a role for artificial intelligence? One for responding to claims when there is a deluge of claims, for appraisal of damage, and possibly for modeling risk.
So absolutely, there's a role in modeling risk. I think several of our member companies are actually taking a look at where AI can play a role, particularly with wildfire risk, where we've had difficulty with the modeling. If you can feed the data from past claims histories, if you can feed in a sort of aerial imagery, there's an opportunity for machine-based learning to be able to use for more predictive purposes. The one thing that we're struggling with is that our data in Canada is fairly fragmented because we don't have a central place that collects all claims data in this country, unlike some other countries. And so each insurer has its own view on risk, and it's not shared. And so that becomes a limitation to a degree to using AI. And so we're actually looking as an industry at what do we do about that? How do we, is there a way we can address it? Your other question, though, I just want to make sure I captured it.
Responding to floods of claims or appraising damage.
Yeah, appraising damage. So there might be a role. I haven't heard of it being used for appraising claims. What I have heard is a shift in some countries to a model called parametric insurance, where instead of having to appraise a claim and appraise damages after the fact, you just say, look, based upon, and I think this gets at your point with the use of AI, based upon our knowledge of what a certain event, you know, if you have a wind speed that reaches a certain parameter, we know how much damage has been done, and being able to pay out claims based upon those parametric thresholds, as opposed to an after the fact appraiser using it. And so that's been used for broad scale, when governments buy reinsurance in the Caribbean, for instance, they buy a parametric policy, and that's how the policy is designed. It says, you know, if you've received this much rain, or if the winds have reached this level, we know how much damage, and it's going to trigger a payout to a government of a certain amount based upon that parametric threshold. That's definitely a way of the future, and reduces the need for all of these individual appraisers going out. We haven't figured out, though, how you would apply that at the local level, like on a household basis. It's more for, addressing a government or a private sector insurance policy.
Well, we have something like that for health insurance, for example. There are predetermined amounts for certain types of diseases, operations, whatever. And if you fall in that category, that's how much you get. There is no need for a specific appraisal for that particular case. It's preset. Okay, you get that much, and it's not a bad system.
Yeah, that's
what about responding to thousands of claims at the same time? Can they?
Yeah,
there?
It's it's a good question. I suspect AI could play a role. Could play a role with that at some point, for sure, to take the load off. So. I don't know if our member companies are exploring it right now. I suspect one or two of the big ones might be, but it does seem like there would be a role there.
So I gather from your three answers that there is not much use of artificial intelligence yet in the insurance business.
It's early days, I would say.
Yeah. Okay.
Thanks, Richard. Richard's last question, I can't help but think about, I think it was in Switzerland, some church put up a way to communicate with God through artificial intelligence. It didn't go over well, apparently. So I'm not equating insurance companies with God, believe me, but there are perils there as well. We've come to 1 o'clock. Craig, thanks very much for not just a great presentation, but for engaging with the gang. Wow, the questions covered the full range of things that you covered, and thank you for a very thoughtful response. I think it'll help all of us think about this really important question for a long time. Don, am I turning it back to you to do, or Frank to do the official closing, or am I doing that? What's going on?
I can officially close, but thank you very much for thanking Craig. I second your thanks there. Craig's been great. We will look forward to seeing that on our website. There is a link for those who want to capture it to the UK Actuaries Report. And if anybody misses it and wants to get it, let me know. Otherwise, thank you all very much for coming. And we look forward to our next meeting, which will be a student noon hour presentation. 3 students from Carleton University on remote sensing. And that will be in February, on February the 20th. Thanks again, and bye.
Thank you.